Howdy, Jacob here. Today we're looking at Graco, company 45 of our high ROIC yield, or screener, sorry. The company was incorporated in 1926, headquartered in Minneapolis, Minnesota. They have a 15.1 billion market cap on 14.6 billion enterprise value. Return on invested capital is absolutely astounding in the low to mid 20s. Revenue growth almost doubled in the last 10 years. So consistent growth, but nothing that is absolutely crazy. But on the margin side, 54% to 52% for gross, relatively flat, but operating margin up from 25% to 29%. So some good things here, straight from the numbers. We see that they have 538 million cash equivalents with no long-term debt and just 30 million short-term debt. So balance sheet, they have more cash on hand than total liabilities. Very safe from that perspective. 5-year average basis, you're probably looking at 300 to 350 million. That dividend is paying out roughly 45 to 50% of their 5-year average free cash flow. So that's not super concerning. Otherwise, other uses of cash are a bit in reinvestment. You can see that their capital expenditures have jumped from 31 million to 200 million. So they are reinvesting. A little bit of acquisitions, not much, maybe a little under 10%, maybe 20% debt repurchases, and then they've been a bit more share repurchases recently, um, but historically it's kind of up and down. So maybe if you look at these, hopefully management is buying back shares that are really cheap, and then maybe when they look more expensive, they're just not really buying back shares, or maybe even issuing them. So interesting from the numbers perspective. However, let's make some assumptions to see how the business looks from a valuation perspective. For growth, I could see let's do 5 and 16 with a 15% return. Margins, I don't like that earnings margins are higher, but free cash flow is still pretty high up there, so I'm not too concerned about that. And then buyback shares, let's say a little bit, but yeah, stock-based compensation is 30 million, so it looks like maybe they outdo it a tad per year. And then from the dividend standpoint, I said it's 45 to 50%, and it looks like they have been raising it. Okay, so let's increase that dividend. So maybe by the end of year 7, we're looking at 60% payout. But again, that's probably not too concerned. 55 to 60% dividend payout, not too concerning given their consistency and have been around since 1920. But really, we're getting to a price that needs to fall quite a bit. And again, that makes sense just looking at super high level at their PE. I'm saying that there's going to be a contraction of PE, and their revenue change with margins are not expanding enough to make up for that. And so from a numbers perspective, it looks like a fantastic company. They do have a bit more capital expenditures than some of the other companies we've been looking at, but still fantastic, gushing cash flow. Just from a valuation perspective, it's just not there for me yet. So thank you, and I hope you have a great rest of your day.